managerial accounting, planning and control, performance evaluation. Now, we indicated in the previous video that there are some weaknesses with the static budget performance report. The first step in overcoming those weaknesses is to prepare a flexible budget and then to incorporate that flexible budget into your performance report. A flexible budget shows what revenues should have been for the actual level of sales and what costs should have been for the actual level of sales. So in order to prepare a flexible budget, we need to know information about what the standard costs and the budgeted costs per unit were for our product. So here is the data that we're going to be using in preparing our flexible budget. The planned volume level, remember, was 20,000 units. Now, the standard manufacturing costs for direct materials, the standard quantity was 3 pounds of materials, and the standard price or cost was $3 per pound. So each unit of finished product should have cost $9 for materials. Then the labor standard was 0.75 or 3/4 of an hour at a standard wage rate of $10 per hour for a standard cost per unit of product of $7.50 for labor. Variable overhead is applied using direct labor hours. So be careful. This isn't hours of overhead, but it's our application or allocation base standard. So 3/4 of an hour is the standard for labor, and that's what we're going to be using to apply variable manufacturing overhead. But the variable manufacturing overhead standard rate is $2 per direct labor hour. So again, be careful to pull the correct rate to multiply times hours. So for variable overhead, 0.75 direct labor hours at $2 variable overhead cost per hour. Standard is $1.50 per unit. So our variable manufacturing cost total $18 per unit. Our fixed manufacturing overhead was budgeted at $130,000 per month, and that is for a relevant range of above $20,000. Actually covers through 25,000 units, not dollars, 25,000 units. Now, we also need information about our budgeted selling and administrative costs in order to complete the flexible budget. The variable selling and administrative was $1.50 per unit sold, and the fixed selling and administrative was $85,000 per month. Now that we have that information, we can prepare a flexible budget, and then we'll be able to do a flexible budget performance report. So let's take this data and fill out our flexible budget column. Okay. Now, the flexible budget, again, is what revenues should have been for actual production and sales. So we actually sold 23,000 units. So that should be at the top of our flexible budget column. Now, sales, the sales price, we can figure out if 800,000 was our budgeted sales and we expected to sell 20,000, then our budgeted sales price was $40 per unit. And $40 per unit times 23,000 actual units produced and sold, our flex budget sales should be $920,000. And then we'll do the same thing for the variable cost of goods sold. Our variable cost of goods sold per unit was $18 standard, and we produced and sold 23,000 units. So $18 times 23,000, our variable cost of goods sold for 23,000 units should have been $414,000. Should have been $414,000. Now on fixed overhead, since that $130,000 was within the relevant range for actual production and sales, the total fixed overhead should not have changed. So the flexible budget amount for fixed overhead is the total that was budgeted, because we're in the relevant range for that figure. So that's $130,000. So our variable, or our manufacturing cost of goods sold, should have been $414 and $130, should have been a total of $544,000. But we actually incurred, or the planning budget was $490,000. So we would expect that variable cost should increase as activity increases. Now, quickly, let's finish out the flexible budget column for the selling and administrative. Variable selling and administrative costs were budgeted at $1.50 per unit sold. So $1.50 times 23,000 is going to be a variable selling and administrative cost of $34,500. And like the fixed manufacturing overhead, our fixed selling and administrative should be at the total amount budgeted. So that should be $85,000. So when we subtract out all of our costs, according to the flexible budget, we should have had net operating income in the amount of $256,500. $256,500. Okay. So we planned for 20,000 units, operating profit of $195,000. We actually sold 23,000 units, so our profit should have been $256,500. Now in the next video, we're going to look at the variances and see what they tell us.